Hello and welcome to our discussion on preparation of the financial statements. Let me recap. We said that every business decision will involve financial items, and all these financial items, that is the incomes, expenses, assets, liabilities, and equity, will find place in the financial statements, and the financial statements are balance sheet, income statement, and the cash flow statement. So in other words, the financial business decisions through the financial items will appear in the balance sheet, income statement, and cash flow statement. Through this exercise, we'll keep on observing varieties of transactions and see how the financial transactions appear in the financial statement. Let me start with this simple example. Started business with cash, which I mentioned in the past. It's a capital, so capital is 100,000, and it is also a receipt. So capital is a receipt. I'm receiving money from the promoter or the owners. Then you have availed the loan. So loan is also a receipt. Okay, the loan is also receipt 50,000, and loan is a source. So then I purchase shares of A. So that means your first time investing that money. So the money that you had, so shares acquired is an asset, and let us assume that we paid, it's a cash transaction. So acquisition of share results in cash outflow and creation of an asset. And you sold all the shares, so it's an income. Sale of shares is sale of shares is 220,000, and if it is for cash, assuming that's for cash, then the sale of shares, there will be a cash inflow of 220,000. Maybe for clarity, let me write down here for cash. Okay, and whenever there is a sale, there has to be the cost corresponding to that because of matching principle. So the corresponding cost is 120. As a result, on the balance sheet, you will not have anymore the shares. The shares will become zero. Then you paid salary. Salary is an expense, and you paid that money, 20,000. So payment and an expense. So expense paid will be an outflow, no outstanding liability. But since you have interest, so interest is an expense, once again because of accrual principle, assuming that is for 1 year, and so it is 1.2. Though it is not mentioned, let us assume that you have paid interest. Okay, so no outstanding interest, so interest paid. So all the financial transactions recorded. So let us find the profit. Profit is equal to income minus expenses. So profit before tax, so 220 minus this. Let us assume that tax rate is equal to 30%. Okay, tax rate is equal to 30%. So tax is equal to 30% into 30%, multiply that, and if that also I'm paying, okay, so tax payment, we pay the tax. Okay, so all the transactions are taken care. So PBT minus tax is profit after tax, PAT, and if no information is given, I keep the entire profit as a retained profit, entire profit as retained profit. So let us find the cash in hand. Okay, so let me pull this up to make space for it. Let me pull this up slightly. Okay, so the total cash inflow is 370,000. So 370,000 is total cash in hand minus the payment. okay, minus the payment is 168,200. So as a result, you're going to have cash in hand. Cash in hand is receipts minus the payment, and cash in hand is an asset. Okay, cash in hand is an asset. Okay, so cash in hand is an asset, so I show that asset. Then the total of sources is 208, and the total of assets is also 208. So that's a simple exercise to show that the financial items will appear in the balance sheet, income statement, and cash flow statement. In the next session, we'll see if some of the expenses are not paid, or in other words, when there is an outstanding expenses. Thank you very much.